How should you value your business in your divorce? Well, the first clue is you shouldn't. You need a professional. It is very difficult to tell the value of a business. There's three ways that businesses are valued, right? The first one is the income method. We're going to look at the income generated by a business, and we're going to use a multiplier, typically about 3.5, meaning that if the business generates income of $100,000 a year, a very rough thumbnail sketch might mean the business is worth $350,000. So you might be thinking, well, I can do that myself. Why do I need an attorney? Why do I need a business valuator? Because that's income, that's profit, not income. It's not the gross funds coming into the business. It's after all the expenses of the business have been paid, including a reasonable salary to the business owner. So there are lots and lots of businesses that by the time you pay the kind of salary that the business owner would demand on the market, there's nothing left. So even if you're filing tax returns that say that business is generating a profit, well, a business valuation expert might just say that it isn't. So I told you there's three ways to value a business, right? The income method is one. The best way, if it's possible, is the free market. If you were going to sell that business on the free market, what could you get for it? Well, for some businesses, that's super helpful. I want to sell a convenience store. Going concern, right? There's probably a ton of convenience stores that have been sold in about the same location. I can just look at how much they all went for. I can look at the gross sales. I can tell you how much that business will demand on the free market. A lot of businesses are so unique that there's not a ready market for them. I'll give you a great example as a law firm. It is difficult to acquire law firms in the market. There's not that many out there. If I want to just look and say, how much is a law firm worth? I'm going to have a hard time finding a comparable law firm that's been sold in the open market and what it went for. So here, this is one situation where a business owner might know really quickly what their business would get on the open market. You've got a pest control service. Well, there's probably been a pest control service very similar. You've maybe even been approached by people, by other companies and said, hey, let me buy you out. I'll give you this much for your business. And if you have that kind of back and forth, those transactions, those offers, and you know them, you might have a really good idea of the worth of your business. But if you haven't been approached by people with offers to buy out, if you haven't looked into purchasing a business, or if your business is not the type that you can easily buy and sell on the open market, you're probably going to need to use one of the other two methods to evaluate the value of a business. So what's the third method of evaluating a business? We call it book value. And what that means is we're just going to sell everything the business has. We're going to sell all the different pieces to the business. If you have an office, you're going to sell the computer, you're going to sell the desk, you're going to sell, all the individual parts. And whatever that brings in, well, we know the business is worth at least that much, right? So book value is usually the lowest value of a business. And we don't use it if we can get a good value using one of those other two methods. But a lot of people, when they look at the book value of the business, they like to try to exclude the most valuable assets the business has, and that's its client list. The ability to reach out and contact those clients and your going concern and relationship with those clients, that has a value. And if somebody is telling you that their business is only worth the tractors or machinery or whatever they own, make sure you get it evaluated by somebody whose job it is to value businesses. They're going to make sure that important assets like the value of a client list, the value of outstanding contracts, don't get left out. If it sounds complicated, It's because it is. It's complicated enough to value a business that I don't do it myself. When you hire my law firm, you're going to actually see in the retainer agreement that I am not qualified to value a business. You need a professional. We will use a professional business valuator, and I work with the best in the business. I can find a business valuator for almost any type of business to make sure that that business is properly valued, to make certain that your interests and what you've put together in over all these years is protected at the time of your divorce. As a family law attorney, almost every business that I'm involved in is in the middle of a divorce, right? And one of the things that becomes immediately obvious to me when there is a partnership in a divorce is whether or not that business used a competent business attorney when they established their business. A business that has been set up by a qualified business attorney is going to address what happens in the event of a divorce. It's going to address control and ownership of the business. It's going to address possibly insurance to provide the value of the business to that divorcing party without harming the business so that it can no longer go on. Businesses that don't have that type of pre-planning unfortunately sometimes get cannibalized in divorce, because when you're running a business, so if you have a partner that you rely on and you depend on, their expectations are that you're going to continue to allow some of your assets to be in that business to help it to function and grow and employ people. And if your spouse is sitting there telling you, well, I need half this value right now, that's going to destroy the value of your business. The good news is that if you have a good attorney, if your spouse has a good attorney, and you're both approaching the divorce as a transaction, it's in everybody's best interest for that partnership to survive. And what you need is an attorney who recognizes the potential danger and can make clear to your spouse the damage that they will do to themselves if their greed affects the ability of that business to perform in the future. One of the ways that businesses can be protected during a divorce is if it was considered before the divorce through a premarital agreement that specifically states that the business will not be divided, or that gives a method that as to how the business will be valued. I also see situations where these same questions, these crucial questions, are answered after marriage with a postnuptial agreement. It's another type of marital property agreement, and it can be just as valid as a premarital agreement. Now, your spouse might balk at this, and in fact, I'll tell you truthfully, I have all kinds of red flags come up when somebody comes to me and says, my spouse wants me to sign a postmarital agreement. But if it is clear and written and crafted with the intention of protecting the other partner's interests and just protecting the business from financial devastation, a good attorney representing your spouse can help them understand the assets that remain part of the community estate and how the agreement is narrowly crafted. The business debt that I see talked about the most at the time of divorce is taxes. If you think you might be facing divorce now or at some time in the future, I'm going to tell you, make sure you file your taxes, because it is very difficult to figure out what the liabilities are going to be for taxes that have not been filed for a business or individual years down the road. And your divorce can end up being delayed, or the tax question is not properly considered, and that can lead to a very, very lopsided division of assets at the end of the day. So, you thinking about divorce? You think your spouse is thinking about divorce? File those taxes. Now, there can be other debts that are part of a business that can heavily affect a divorce. If you have a business saddled with enough debt, it can rob the business entirely of its value, meaning that there's little or nothing to divide because of the debt that's been taken on. When we divide assets at the time of divorce, we all do it in an Excel spreadsheet. And we put on there all the assets as positive numbers and all the debts as negative numbers. And the assets are pretty easy to move back and forth. But I don't allow my clients to move those debts back and forth in most cases. And that is because that debt is owed to a third party who is not part of your divorce. And if you signed a contract with them, they're still coming after you. And so that debt needs to stay on your side of the spreadsheet. And it sometimes, if you've got all the debt on one side, the court's not going to give 100% of the assets. And once again, you can be looking at a very lopsided spreadsheet, much more lopsided than what the court would do if all they were dividing is assets. I'm Ruby Bolton, the founding attorney of the Bolton Law Firm. If you have found this video helpful, please click below. We have more information that we'd love to share.